Hi. Let's learn about funds from operations, FFO. Funds from operations is the figure used by real estate investment trusts, REITs, to define the cash flow from their operations. Real estate companies use FFO as a measurement of operating performance. FFO is calculated by adding depreciation, amortization, and losses on sales of assets to earnings and then subtracting any gains on sales of assets and any interest income. It is sometimes quoted on a per-share basis in lieu of earnings per share, EPS, when evaluating REITs and other similar investment trusts. The formula for FFO is FFO equals PSG, 2, where FFO stands for funds from operations, NI is net income, D is depreciation, A is amortization, PSL is property sales losses, PSG is property sales gains, and 2 is interest income. All these components are listed on a REIT's income statement, and FFO is calculated by adding depreciation, amortization, and losses on sales of assets to net income, and then subtracting any gains on sales of assets and any interest income. FFO is a measure of the cash generated by a REIT from its regular, ongoing business activities. It should not be seen as an alternative to cash flow or as a measure of liquidity. FFO excludes one-time cash inflows, such as income from the sale of an asset, and only includes income from business activities. FFO compensates for cost accounting methods that may inaccurately communicate a REIT's true performance. FFO also helps investors determine whether the money is being used effectively by management. Additionally, FFO per share provides a measure of how much income is being generated on a per-share basis. Real estate analysts are also increasingly calculating a REIT's adjusted funds from operations, which subtracts any recurring expenditure that is capitalized and then amortized, as well as any straightlining of rents. AFFO has gained traction as a more accurate estimate of a REIT's earnings potential. For example, Simon Property Group, a popular mall REIT, reported funds from operations on its 2017 income statement of $4 billion, up 6% from 2016. The firm's net income totaled $2.2 billion. To arrive at FFO, the firm added back depreciation and amortization of about $1.8 billion, and further adjusted for other smaller figures. Funds from operations measure how much cash a real estate investment trust generates from its regular business activities. Keep in mind that FFO doesn't include the gains a REIT makes on the sale of its property. That's because this doesn't count as an ongoing or recurring activity. REITs are required to disclose their funds from operations on public financial statements. You can easily find this figure on an income statement within the footnotes. You can also calculate FFO by adding together the REIT's net income, depreciation, amortization, and losses on property sales, then subtracting any gains on property sales and any interest income. The FFO represents the operating performance and takes net income, depreciation, amortization, and losses on property sales into account while factoring out any interest income and gains from property sales. The cash flow from operations includes the total amount of cash generated from a REIT's normal business activities. Here are 5 key takeaways. 1. Funds from operations is the figure used by real estate investment trusts, REITs, to define the cash flow from their operations. 2. Real estate companies use FFO as a measurement of operating performance. 3. FFO excludes one-time cash inflows such as income from the sale of an asset. Instead, it only includes income from business activities. 4. A REIT's adjusted funds from operations subtracts any recurring expenses capitalized and then amortized in addition to any straightlining of rents. 5. REITs disclose their FFO in the footnotes of their income statements. Hope this would help. Thanks for watching.